Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY, the Qs, and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of the video today, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick off the S&P analysis as we always do with none other than our sectors. Who was leading, who was losing, and where was the weight? The XLE for the energy sector led the pack today, up 1.63%, whereas down at the bottom of the barrel, we see the XLF for financials down 1.61%. As we know, energy is a risk-off sector, so not great to see that at the top of the list, and XLF for financials is a risk-on sector, so again, not really an ideal situation to have that back down at the bottom of the list. In terms of the heavier weighted sectors that we're always monitoring, of course, that's going to be the XLK, the tech sector, the heaviest of them all, up towards the top of the list, but only because it was down the least out there from a percentage basis from the prior day's close, down 0.3%, whereas from today's open, notice it was a little, well, not a little, much nastier, down 1.36%. We'll take a look at that chart in depth in just a moment here. Of course, the XLF coming in as the second heaviest weighted sector that we are watching. That was, of course, down at the bottom of the barrel. We already covered it. Then the XLV, which, yes, by market cap is technically the second heaviest weighted sector, but in terms of our ranking, it falls as number 3, and that was down 1.44% from the prior day's close, and from today's open, 1.79%. Let's quickly check in on some of these structural charts just to see how things are continuing to unfold here as we're almost coming into a turn in the marketplace. So energy remains as sort of a risk-off look, really, up here at these highs. I would have thought on the exhaustion gap up, we could have seen a little bit more follow-through to at least retest the breakout point around 84. It simply wasn't in the cards. So this holding up as well as it is right here strikes me as a risk-off indication, not a good sign for a better bottom in the S&P 500. Remember that when oil and crude essentially is strong, it means that the consumer is taking a little bit of a hit, and your marketplace is never generally as strong when you have expensive oil prices. So energy being a reflection of that. Utilities are going to be in the same camp here, but slightly better, slightly better. The reason I say that, of course, is because we are still off of those highs. We're well underneath 77 still. We are technically playing around nicely in this overall box. As long as we remain in the box, fine. I'm not overly concerned with it, but if this bull flag really starts to get some tailwinds behind it and break out to these highs, that would, of course, become more of a concerning look. So I'm monitoring that closely here inside of utilities. Next up, we've got the XLK, again, perhaps the most important sector for the S&P 500 overall, and something that's going to sort of combat or tone down the bearishness we were just discussing in the 2 risk-off sectors is, of course, the fact that this double bottom is continuing to hold up quite nicely with these 2 days of consolidation happening above the neckline from the overall pattern. I'm willing to give it a little bit more wiggle room to technically come down and fill the gap around 137.50 before I would start to say that this is becoming too deep of a pullback to remain as optimally bullish in the XLK. So continuing to like the look that we're seeing here, but really watching those 2-day lows, I would not want to see a massive flush here that then gives us a daily bar that might look something like this with a close underneath that level I just mentioned as a line in the sand, 137.50, just as a reminder. Something that I do like that I'm seeing here in the XLK is the fact that volume is tapering off as this consolidation is unfolding, and we will see that in the market internals as well in just a moment. So XLK, as long as it remains above these levels, you know, this is going to take a back seat to me, and this is really the primary data point, remembering how heavy of a weight this is for the S&P. As long as this is bullish, I'm not flipping my stance quite yet for a fake out in the S&P 500. Next up, we've got the XLI, really nothing to talk about here, remembering that this is a fairly lightweight sector. You've got a nice breakout point forming here, forming sort of a bull flag look. Looks decent as long as it wants to put upward pressure on the S&P 500. Sure, we'll take it. Even if it wants to break down a little bit, that's A-okay. I do think that it could find a little bit of a higher low. I'm not as concerned with the pattern unfolding here. Next up, we have materials, same exact thing that we just discussed in industrials. Overall, it's inside of this balance range right here. We're close to the midpoint of the range. We no longer really are threatening a breakdown of this 80 level, so I'm not overly concerned with the structure we have here, really lightweight sector. XLY, consumer discretionary, this is certainly a little bit more important than the prior 2 we were just discussing. And again, I really like the 2 days worth of consolidation that we're getting at the highs, the slight decrease in volume as this consolidation is unfolding. We did make a new higher high, and again, I am willing to give it a little bit of pullback room here into roughly that 149, remembering the importance of the support from in here led to a breakdown. Let's see if we can ultimately form a higher low off of that and then maybe go, or if it just wants to break out up and over the 2-day highs, that would be fine by me as well. Noting that, again, we've made the move all the way off the lows. We're starting to get that sideways digestion here. The next leg is going to be really critical here in the XLY. So watching for further sideways sideways to build out the flag, or just taking out the 2-day highs. Anything that starts to break down under 149, again, starts to become more of a concern, a red flag for the S&P 500. Based on the current pattern, the 2 days of consolidation, doesn't strike me that, the first indication for early in the remainder of the week, so I'm talking about early on in the sessions in the remainder of the week, that we just want to do something like this back down towards the lows. Now, is that a possibility? Yeah, anything's always a possibility in the marketplace, but given what we've seen here, and again, what I'll point out as we move through today's sort of analysis, I don't think that it just wants to break down, relentlessly from these levels, given the nice little consolidation we've had so far. Next up, we've got real estate. Again, a lighter weight sector, but remembering it is more of a risk-off sector, noting how it's pulled in here and it's not leading this charge to the upside. Strikes me as a decent look. There's still a high probability that we do form a higher low here. You'll notice the lower wick. So chart seems fine to me, not overly concerned with real estate. Communications, slightly concerned with what we're seeing here. And the reason being, of course, is we do have a bearish engulfer candle. Notice that we did make a new higher high and we did make a new lower low. Now, don't get me wrong, we are above the neckline of the double bottom from right around in here. So I'm not concerned from a structural breakdown perspective just yet, but from a psychological perspective, we certainly should have seen a little bit more follow through up and over those highs. That probably trapped a couple of, or not a couple, but some long-sided traders there with poor trade location. Those people fuel the fire to sell into the pullback and push the market lower. So overall, I'm a little bit concerned with potential for trapped longs up at these highs, which could provide selling pressure in the XLC into the remainder of the week. So I really just want to see this base out and go sideways here and not necessarily break down underneath that 59. If it does, of course, then we do flip our stance slightly in the SPY, noting that this is a heavier weighted sector, but it's certainly not top 3. Continuing along, we have the XLP for consumer staples. What's going on in this name? Reasonable pullback. I mean, guys, look at the work that was done here after this nasty fall apart from that sort of target earnings debacle. I mean, give it a break, right? This thing can certainly pull back here and it's still fine, right? Overall, there's still a high likelihood that we find some sort of higher low. I'm not overly convinced that this just wants to rotate all the way back down towards the lows, remembering also that this is technically a risk-off sector. To see it just sort of playing nicely in this overall range, fine, perfect. As long as it's not leading the charge to the upside, to me, that is a good indication. So XLP, sure, I would like to see this turn into a bull flag. I would like to see the chart improve a little bit and get some more stability in this area, but I'm not overly concerned with the structure just yet in terms of looking for that next breakdown. I just don't see it currently. Next up, we have the XLV for the healthcare sector, a really important sector, of course, by market cap, second heaviest weight. Sure, we did get a much more aggressive pullback in the healthcare sector compared to some other things we've seen today, and we did actually take out the neckline, but notice this is our last saving grace. It, of course, is a support trend line coming from the lows, our next higher low for the double bottom, and we are still above that on today's pullback. Now, because we did create a new higher high, so this, which was above our neckline, right, we were looking for buyable pullbacks into the support trend line. If we bounce here, form a lower high, and then attempt it again, that's where you look for the trend line to break, and you look to fill up the triangle into the lows around 125. We currently do not have that situation. As the selling was unfolding, again, look at what's happening with volume. It's tapering off. So I would be of the belief that if we can print a hammer candle down here, if we start printing intraday 30-minute, 15-minute patterns down here that would signal a reversal for higher, this is an area where you have tight risk reward. You can look for a stop right here and a reversal back up closer to these highs. Overall, just using this as a gauge for the overall market, I would say, it's not a major concern just yet, noting we're still above the support trend line if you want to boil it down to its simplest form. Last but not least, we have the XLF for the financial sector. What's going on in the banking industry? We'll, of course, take a look at rates as well in just a moment here. Overall, again, a little bit more of an aggressive pullback unfolding, but in this one, notice the difference, right? Well above the neckline of that double bottom from right around in here. We talked about this one being one of the first to actually show and improve in terms of relative strength, and I do still think that it's kind of in that category here, noting that the sellers couldn't even fill the gap, right? So again, in terms of gauging how strong the sellers have been over the past 2 days, really the Tuesday session was just a balanced day, and again, we'll see this stuff on the internals in just a moment, but the sellers do not strike me as just pedal to the metal, panic selling, drive this thing lower, ditch everything. If that were the case, this gap should have filled no problem. Short-term nuanced traders shouldn't have been able to pick it up long here and support it back for higher. So overall, I do think the sellers do still remain weak, and this is just another indication of that. As long as we're above the neckline in the XLF, I do think we we can get a break and retest type look. Your long entry is either waiting for a hammer candle that comes down a little bit lower, long over the high, then looking for higher, or if you're a little bit more conservative, right, you're looking for a break of this high, enter here, next higher high should be produced after forming a higher low for trend reversal. So overall, based on what our sectors are telling us, I do still feel like a number of things are falling into the cautiously bullish category, with the caveat that some of the risk off sectors are still, not really showing us what we want to be seeing. If we just take a quick peek at our ratio grid, this will make it simple. Then we'll jump on over to the TNX for our interest rates. In the ratio grid, again, very, very simple. Notice how the XLK continues to improve off the lows. The descending triangle is sort of getting to that point where it's either going to happen or not. We're either going to break up and over that declining 50 SMA, which is the gold line, and negate the pattern of the descending triangle. That would be a healthy look. Or we'll roll over a little bit here, and then let's see if we can catch ourselves for a higher low. So I'm not overly concerned with this because it's not sitting dead on the lows. XLV for the healthcare sector, aggressive pullback into the 50 SMA, but I mean, look at how this thing has been acting, right? To me, it would seem likely that we find some support here and then maybe continue. As long as the XLV itself finds support at that trend line we just mentioned on the chart itself, fine. I don't really see a cause for concern just yet. The major ones that we still want to see improving, or really the major one singular, is going to be the XLY off of this big low. Still a lot of distance here between that descending, there we go, 50 SMA here on this chart. Overall, could be a potential for a inverted head and shoulders, right? Something that does this and gets us back into that area to more neutralize these risk on sectors and get them looking better as a set overall. XLF trying to form a higher low above a descending 50 SMA, the gold line once again. So I really like what we're seeing here. As long as it can do that and respect that 50 SMA going forward here, again, I think it's just sort of marking the change in sentiment in terms of risk on, risk off in the marketplace. At the very bottom, we've got our 4 risk off sectors. Notice that the XLP continues to sort of degrade or just go sideways down here. Same thing with the XLRE for real estate, really just sideways. What we didn't want to see, again, was this perk back up in energy. It unfortunately did. Again, that's one of those minor red flags that I'm continuing to monitor. And then in the XLU, again, it would have been better to get it into the 50 SMA and sideways, kind of a similar look to what we had in the XLP. Currently, these are the 2 thorns in the side of the S&P 500 overall. Let's continue back on over. And by the way, guys, just as a quick FYI, if you don't know what this grid is, I've got a whole video on how you can set this up in the top right-hand corner, so feel free to check that out. Let's go back on over now to our charts and take a look at the TNX, which of course are our interest rates. Notice that we've gotten a little bit of lift here in the TNX, which again is a slight cause for concern. Remember that in the past couple of videos, we were talking about this head and shoulders pattern right here, acceptance underneath the neckline. Well, we're right back above that. And this, of course, is going to continue to put downward pressure on the XLK itself. So I want to see this go sideways. I do not want to see this up and over 3%, right? This is a decimal technically here. It's not 30, it's 3%. If rates go back above 3% in the TNX, again, I just don't think that's a good thing for our S&P 500, really, because of the impact that the rates will have on our XLK. Of course, the tech sector, the heaviest of them all. So continuing to monitor that here on this particular chart. Last but not least, for a behind-the-scenes look, we'll take a look at the VIX. And this, again, is just one of those things that I'm still scratching my head as to why this is going on here. Notice that we're still in the box, right? We did not get that aggressive breakdown or, rally back higher towards the top. So again, another little bit of a red flag as the market's going sideways and digesting the overall move, right? The S&P is just getting 2 days of sideways balance. Why is the VIX not collapsing underneath this area of support just a little bit more, right? And if that were to happen, we know that in the VVIX, which of course is the volatility of the volatility index, this should have perked back up a little bit somewhere in here. Simply not the case currently, given what we're seeing. So overall, volatility, it doesn't really strike me that we're in a stable place just yet. This is still one of those sort of red flags, warning signs, if you will, the fact that we're remaining in this box, even after some consolidation, which in my estimation should have brought us down out of it. All right, enough behind the scenes. Let's have the rubber hit the road here with the S&P 500 itself. What do we see in the S&P? This is the product. What do we see? So here we go. Balance area well inside of the expected move on the weekly range. Notice that we're resisting right at this 415.50. That will be a breakout point. Carry that level forward. We have 2 equal highs there, even 3 if you want to count the high from last Friday. A couple of interesting nuances that I don't think you'll see here on the daily time frame are going to come from the 30 minutes. So let's pop on down there now. There's a couple of things I want to point out here. First one is going to be that on today's selling, which of course was spurred around that 10 o'clock news release, notice where the selling stopped. Again, a very, very nuanced place. We talked about this in the pre-market live streams. There is the string of single prints. There we go. From the market profile, we'll see that in just a moment. That's exactly where the selling stopped. We caught ourselves and now we're higher, right? So this overall, this move, sure, we're getting a little bit of pullback here. Remember that it was all take and no give from the buyers as this rally was happening. Well, now we're starting to digest that move a little bit. And to me, the fact that we're bouncing off of these very nuanced levels strikes me that sellers aren't really strong. If a bigger seller was present here, they wouldn't have cared about that level, right? They would have just blasted it right on through. Panic, sell the market, ditch everything, it wouldn't have mattered. But this is such a nuanced level that short-term traders are really the ones who are covering here. So the shorts in the short term are covering here, and buyers with a short-term perspective are buying there, giving some lift, right? So overall, I think the market's in control of the short-term traders right now, and momentum in the short term is still definitely up in my estimation. So that's what I wanted to point out here on the 30-minute time frame. Overall, a line in the sand is, of course, the neckline of the double bottom still around 405. Continue to carry that level forward as important. It's also the low end of the weekly expected move. There's two Fibonacci perspectives I want to share with you as well before we move along. So coming in from the low of the true move up to the high, notice that your 38.2 is just underneath that 405, but if we do something like this and I activate that and pop this up to here, which would be the start of the rally technically on this hammer candle, right? We take out that high, then it's off to the races. Now your 38.2 is coinciding perfectly with that 405, just further strengthening the case that that will be an important area of support. And then lastly, coming in from the breakdown high here, up to, or rather not up to, but down to this, you'll notice that we're trying to resolve the 38.2 from this perspective. That's not really the critical number that I want you to focus on here. If this low is going to be quote unquote safe, then generally speaking, we want to see the market up and over the 61%, 61.8% retracement of the Fibonacci. So I just wanted to point out from here that there is some still some work to be done before we can classify this as, again, quote unquote safe. Nothing's ever technically truly safe in the marketplace, but there's a higher probability that you do not go here if you can recapture that 61.8. And just to give you the same thing from the true high up there down to this low, it's again very similar to this level around that 430. So I did want to point that out. Meant to talk about that in the weekly watch list video on Sunday, but we had forgotten. So with that being said, I'm going to bring it up on the internal screen. If you're not familiar with this screen, go ahead and get familiar. Top right hand corner is going to tell you what this is, how you can set it up, and how it'll help you make better intraday trading decisions. The main takeaway that I was sort of alluding to in the sector portion of today's presentation is the weakness in volume. Remember that we're always looking for negative 300 million or positive 300 million to classify significant reads in the S&P 500. Notice that on all of the up days, we're well above, well above that 300 million mark. And on the down days, at least this week, we haven't even been scratching. Like, this is a day that you pay attention to, right? Look at how it's been recently. On the past 2 days, really just sideways and muted reads, not, hardly getting to that negative 300 million mark. So from this perspective, again, I'm seeing this as healthy consolidation. Volume is not aggressively lower. It's light, don't get me wrong, but it's not like everyone's just running for the exit sign and dumping everything. The same thing would hold true in our advanced decline line. Remember that we've been so wall to wall in this thing over the past couple of weeks. So to see the selling pressure, sort of base out above negative 1500 or bounce off of it here instead of get under negative 2000 strikes me as an okay signal, right? This is not the same type of selling that we've been seeing over the past couple of rounds to the downside. And the same thing is going to hold true in your tick. I'm not even going to zoom in all the way. Just notice the really aggressive down days have cumulative builds that look like this. What did we have over this week? Really flat, really benign, working their way back towards zero on today's session. So again, the selling pressure that's out there is much different than what we've seen when everyone was just slamming the button saying, get me out of this marketplace. I don't want to be involved. There's been a clear shift in tone. All right. That's what we've got in the internals. Let's quickly take a look at our market profile. If you're not familiar with this, I've got yet again another video for you in the top right-hand corner. You're lucky I've got all these resources for you. Nonetheless, what do we see in this one? Okay, so here is the holiday trading session. This is going to be a critical level that you should carry forward as a target if we start to see a break up and over the 3-day highs now, okay? And you can see that here on the market profile. Again, breaks of roughly 4170. You want to target 4200. Okay, nice round number, a psychological number, and also that pre-market sort of high from the holiday session where there was really light trading volume. On today's session, you can clearly see that we have a string of single prints and weak volume as that selling pressure came in around 10 o'clock. I would carry that forward, so your level that you want to pay attention to, this is actually going to be classified as a mechanical level because it's very similar to the point of control from the Tuesday session. So if we can take out 4130 to the upside, this level right here, I would expect to move through this thin structure with some relative ease and come come back up for that reattempt of the 3-day highs, which we just pointed out, around 41.70. Point of control on today's session and value area has shifted lower, so I would have that fall into the bear category. But again, weigh that, so value shifting, with overall the type of selling that we've seen, the amount and pressure of selling that we've seen, what the sectors are doing. The shift of value to me is really just an indication of further consolidation and pullback instead of outright bearishness. We don't really have any poor lows, poor highs that we should be referring to, and I did want to also point out that, again, we came right into the string of single prints here. We talked about that on that 30-minute time frame, remember? So we finally broke that prior day's low. The Tuesday low went right to the base of the single prints. Again, a short-term trader is probably the only one watching that level. So the fact that we supported here and went higher, to me, in the short term, that's a bullish indication, all right? Let's go back on over to the platform here, round out the broad market with the QQQ IWM as well. Then we'll get into the core list of companies, and I'll send you on your way with 3 trade ideas. What do we see in QQQ? So double bottom, just like in the SPY, still intact. Notice that we are getting the 2 days of balance above the neckline here at 305.50, watching for further consolidation there. We're in the midpoint of the overall weekly expected move. Doesn't strike me that we're extended. Overall, the one concern I have about this chart is more similar to what we talked about in the XLY, with the engulfer on today's session, right? Technically, we did make a higher high up and out of the prior day's range, and we made a new lower low underneath the prior day's range. So, in general, why was there not more momentum to the upside, and why was there not more momentum to the downside, right? So, in my estimation, still falling into the bullish, cautiously bullish consolidation category. I'm not willing to say that this is outright bearish until we start getting candle closes underneath 297.50. Willing to give it a little bit of consolidation to the low end of the weekly expected move, as well as if we take a look on the 30-minute time frame, do something like this. Notice this is kind of where that pullback was, right? Boom, right into that 297.50, also coming from prior structure in here, support and support in there as well. So willing to give it a little bit of wiggle room. Here's a relative strength perspective, right? Remember what we just discussed in the SPY. Remember the SPY went right to the bottom of the single prints from Friday's session. In the SPY, we filled the gap. The QQQ has not filled the gap. Again, if the sellers were stronger here, why were they not able to do that on this drive lower on this morning session? Or at least just not leave it lower like this for a bear flag and then continuation into the remainder of the week. I'm not saying it can't go lower, but to me, the sellers don't really seem to have all that much strength here as we're rounding out this shortened holiday trading week. So that's the 30-minute time frame. That's the QQQ as a whole. Let's quickly just keep you up to date. Again, we'll do the same thing with our Fibonacci's. Notice that your 50% is aligned with the line in the sand that we just pointed out. And if we come in from the highs down to the lows to sort of consider these lows in here, quote unquote, safe, again, you're going to want to see the QQQ up and over 337.26. Obviously, that's a long shot away. I'm not saying it happens this week. Clearly, I'm just giving you that as a reference point. Next up, we've got IWM Russell 2000 and the small caps. This one perhaps looking the best, just noting that we do have a hammer candle forming right off of the low end of the weekly expected move. And to boot, if we drop it down to that 30-minute time frame, look at what we've got here, right? If you take this high, this consolidation pullback low, the weekly expected move low, it's just all perfectly there at 182. So to bounce off of that strikes me as a really good look here that, again, short-term traders are controlling this marketplace, and we know short-term momentum is clearly higher. Your next long entry, or just a bullish indication for the marketplace overall in IWM, right, because small caps act as sort of risk on, risk off, is a break of that resistance trend line that we've just pointed out. If we can crack that, boom, I think we're probably back off to the races here, and that might coincide nicely with a breakout in the SPY and the QQQ. So far, I've been discussing things in quite the bullish light, but I do want to just remind you, take a little pause here and say, remember, short-term momentum is higher. It doesn't mean the market can't go lower. So we're waiting for breakout points. We're waiting for those 3-day highs, and we're waiting for confirmation in the internals to support the theory that we have a bullish day on our hands. We're looking and favoring upside, but knowing as well that the daily downtrend is still technically intact in many of these things. Weekly downtrends, rather, are still intact in many of these things. I want to just put a big cautious tag on the bullish sentiment that I've been talking about so far in the video. You might call that a cop-out or whatever, but that's just ultimately how I'm seeing the market currently. Next up, what do we have in the core list of companies? We've got Apple here. Again, concerning look with the incremental higher highs. That's not really something that I like to see. It doesn't set up a clean entry point to the upside. And as a matter of fact, it reminds me of what we see in like this area of the chart right here, right? Big impulsive move off the lows. We start making these incremental higher highs on a day-by-day basis. Think about it from a psychological perspective. As you're a long starting to take the breaks of the prior day's high or just looking for follow through up and over this area of resistance, you don't get paid, right? And it happens again the next day. They don't get paid. Sure, it was maybe a little bit, but overall, we keep closing weak inside this general area. If the longs get too far ahead of themselves here, it could easily lead to enough liquidity to sell out of those longs and again, produce something that looks like this. So that's my one concern about the incremental higher highs that we've been making here inside of Apple. Overall, again, I would echo the sentiment that the selling does not seem like serious selling, like, get me out of this thing, panic selling. Look at what's going on with the volume. Look at the candle size bodies. They're not really that large, right? So overall, I would still remain cautiously optimistic for a bull flag to form somewhere in this general area and then look for follow through higher. Remember that 152.20 or 152.25 is a big level inside of Apple. We sort of wicked into it on today's session. I wouldn't just, immediately think that, okay, we're going to break out into the trend line on tomorrow's session. Maybe some consolidation, build out that flag first, and then after we've sort of built up some energy in here, that's where that break can happen. And just to give you an idea of where that's coming from, right? There's your big 152.20 level, all right? So that's what I'm watching there. I will start to become more bearish in Apple once again if we can come down, fill the gap, and start closing underneath 144.25. Next up, we've got Netflix. Netflix is in a do not touch zone in my estimation. I sort of touched on this not to use the same sort of word, touched on this after I just said no touch zone, but it's not really poised well, shall I say. Wow, all over the place with the grammar. It's not really poised well for a decent move. Notice that we had a wall-to-wall move in this general area of balance right here, and we've closed right back down on the lows. We are technically making higher lows, and we do have a higher high, so if you wanted to draw on a support trend line like this and look for a buy point somewhere around here, I would, that seems reasonable to me. But overall, the setup in Netflix does not really strike me as being there quite yet. I would love to see further consolidation and then this level overall break at 202.25. That strikes me as the next long opportunity in Netflix. Anything that continues to muster around in here strikes me as choppy, to be quite frank with you, noting that we traveled the entire range there in 1 day's worth of trading. We never really saw that explosive sort of short squeeze, quote unquote, that we were discussing and sort of eyeballing for on the break of 190, right? There was no explosive move in there. So overall, Netflix kind of on a back burner for me. I've got to wait for a better consolidation period or breakout point to form here. If it wants to take out these lows around 190, again, that support trend line is going to be somewhere. Let's go ahead and just actually draw it in here together. So support trend line is going to be, if we do something like this, on tomorrow's session at least, roughly aligned with 187.25, somewhere in that general area. So if we start supporting in here, you'll know why. But if it cracks, that's where it opens the door, of course, into 176.44. And then, of course, it's off the radar for the long trade, obviously, up and over here. Next up, we've got Tesla. Strikes me as a much better watch. So notice how we did make the higher high, but we pulled back and had a nice inside day on today's session. So overall, I like what's going on here compared to what's happening in Apple. This strikes me as a better breakout point around the 780.75. If we can turn around and boom, crack that on tomorrow's session or into the end of the week, that is definitely a long setup I am looking for up and over that level into 823. After that, we've got the retest of these lows at 861. That seems like a little bit of a stretch into the remainder of the week, remembering that it's a shortened week. We've only got 2 days left. But overall, remaining optimistically bullish in here, cautiously bullish, I should say, rather rephrase it that way, for a flag. And if it takes out the 2-day lows, here's an interesting trade. You've got to be very quick, and it's got to be right or right out. If you take out the 2-day lows here, just look for a backtest of 700. I would not push your luck further than 700, but again, just 2 days worth of balance, very simple setup, either long up and over the highs or short down and under the lows. With the short setup in this particular instance, again, you don't want to overstay your welcome on the short side. A better sort of look of this would, of course, be on the 30-minute time frame. Notice that on the exhaustion gap higher, we fill the gap, but then we just kind of consolidate right back up towards the highs. I mean, just like we talked about in the QQQ and IWM, look at where we are in relationship to what the SPY did, right? The SPY pulled back, filled the single prints here. You're seeing relative strength in Tesla, noting we could not even come in and technically fill this small gap in here or the single prints underneath that area there. So overall, I like it, holding up at these current levels. Next up, we've got AMD. I'll quickly flip it on over to the daily time frame. There's not a whole lot to talk about here. 2 inside bars underneath, bubbling up against that resistance trend line. For me, it's got to be a break of the trend line one way or another, here or here. I've talked about it in the live stream. I'm being patient on AMD. I don't really think there's a reason to jump the gun here, try to buy it on a pullback in this range. just be patient. It's either going to break the resistance trend line and go and move up to some of our targets. At this point in time, a break here could lead you, give you enough meat on the bone into 106, but after that, really watching for that 111.25. And to the downside, we're not even really going to discuss downside targets, but the support trend line is much lower. If it's happening this week, it's going to be back sub 100, obviously, closer to 96, we'll call it for round number's sake. Next up, we've got Facebook, a little bit of a conundrum here in the afternoon. I believe it was the COO. You can correct me in the comments if I'm wrong about what C-suite position resigned. There was someone who stepped up and is going to fill the spot. Nonetheless, a little bit of volatility here. You can currently see we did break that support trend line. And again, this is best illustrated on the 30-minute time frame. If we zoom in here, perfect fit, right? We were watching for this to act as support, and it started to, but again, when that news gets released, it's pretty tough for technicals to hold up no matter what the sort of deal is there. Now, is it an overreaction? Maybe, but from a technical perspective, notice that we do have a lower high and we've closed underneath the trend line. So in the short term, bears have regained control here. We do have a big hammer candle and we've closed in the midpoint of that overall range there, which is, slightly more indecisive than outright bearish. But after I've just pointed out that we've closed underneath the support trend line after a lower high, I'm not quite sure I would be fishing for rebound longs at this point in time, right? Let it prove it to us that it wants to come back, do something in here, form a breakout point, and then we'll continue after that. But currently, Facebook is probably a hands-off move into the remainder of the week unless there's just an obvious intraday setup that starts to unfold. Next up, we've got NVIDIA. What's going on in this one? I really like the setup that's continuing to unfold here. Notice that you have a balance area, and we're consolidating above. We do have the lower high here, so we've consolidated nicely now. We're still above the 182.25. If we take out the fibs here, well above a 38.2 Fibonacci if I do something like this. So there's room for consolidation as long as we're above 180, it strikes me as healthy inside of NVIDIA. Then watching for follow through simply to the top end of this prior range at 200. It's also a nice psychological number. If we do happen to break down firmly underneath 183 roughly, that general area here, and we're flirting it with it in the post market, don't get me wrong, I can certainly see that. Then again, I wouldn't necessarily be looking for shorts to go all the way back down here, but maybe you're just looking for some of a retracement through that earnings day where it was just, buy. It was literally relentless buying, right? So probably just back down to somewhere in here from that earnings day, right? Maybe back down towards 172, which would also be your 30-minute 200 SMA. So a breakdown of this area, just like we talked about in the IWM, your long is up and over the resistance trend line, and your breakdown, if it comes underneath 182, 183 that we just discussed, don't overstay your welcome, but your target could be this general area around 174. Next up, Softy. What do we see in Microsoft? Taking a quick peek at the daily time frame, more like Apple, the concerning look with the higher high and the higher low, incremental high there. Again, you're just asking for longs to get trapped at these highs. They're not getting paid. Could lead to a dump. The one saving grace or difference here inside of Microsoft is clearly the break of the resistance trend line. Now, it's sideways through time, so don't get me wrong. It's not as bullish as a pure breakthrough price that does something like this and then consolidates up here, but nonetheless, it is breaking. We are, of course, making a new higher high from here to here. I do think there's a possibility we pull back for a higher low, consolidate, do something like this, and then the next leg is spurred inside of Microsoft. So just to give you some numbers to pay attention to, my downside line in the sand has to be 267. As long as we consolidate above that, fine. Bull flag sort of look here, looking for follow through to the upside. If we crack it, that's where it becomes more concerning and we could head back down towards these lows. It would also be a fake break of the resistance trend line. Currently, based on the incremental higher high and incremental higher low, again, I'm quite skeptical about just taking immediate breakouts into the remainder of the week because of everything we've just discussed. So that's Microsoft. Let's move along. Next but not least, we have Amazon. Last but not least, there we go. Last but not least, the beast, Amazon. Big inverted hammer on today's session. That's a pretty ugly view of the chart. There we go. Happening at resistance here. It's been up aggressively 1, 2, 3, 4, now 5 days, although it's a red close, right? It's still up. 5 days aggressively inverted hammer. This could certainly be in store for a bit of a pullback into the remainder of the week. Your main watch is going to be 2,300. As long as we're above 2,300 in Amazon, we're above the neckline of the double bottom from right here. Strikes me as healthy. If we crack underneath it, you're looking for 2,200 and then potentially the lows in here. Based on the current look and the strength in Amazon, I would think that this is probably a more likely scenario, some sort of consolidation or pullback to 2,300, not a breakdown to the 2,200. For continuation consolidation, your next breakout point after we put in some sort of flag like this or consolidation, whatever, is up and over 25.20 inside of Amazon. All right, that's going to do it for the core list of companies. Let's quickly get you through these three trade ideas. CRM is going to be the first one. They were an earnings candidate from last night. And on today's session, again, you can see a clear inverted hammer. That, of course, is a bearish implication. Where is it happening? Right off of your daily 50 SMA. Where else is it happening? Right next to resistance from a prior set of highs. What's the daily trend? Well, if we scrunch it up, I would certainly say that this is down. What do we have underneath us? Well, I would say that this is an earnings gap. So there's very little structure in there if the sellers continue to step up here. So breakdowns of today's low get us to 167.28. Let me quickly clear up these two levels right here and instead give you the breakdown point. If we quickly flip tools, there we go. That number is going to be 174.40. Taking that out to the downside should get us closer to that 167.28 that we just pointed out. Depending on your time frame, if you're a longer term trader, entry here looking for the low back here, right? So that's pushing it a little bit, but that would give you enough wiggle room to keep a stop up here. That's roughly a 2-to-1. You'd want to move that to break even as quick as possible. So if we could get like the next day to close in the gap, stop goes to break even, you're monitoring for a continuation, right? If you're a scalper, short-term intraday trader, you're just going to wait for a pattern to unfold there, right? And a 5-minute pattern will give you some sort of stop loss to use. That's your CRM. That's your short trade idea on that one. CSCO, Cisco, is up next for a trade idea. This is on the opposite side, the long side, and a very similar sort of look. Similar sort of situation, at least in terms of what we have ahead of us, which is a big gap. So up and over 45.60, 4-day highs now, breaks out from this little flag consolidation right here into the gap overhead, which fills up at 48.20. That's a long setup. Any further pullbacks or consolidation, as long as they're above this 44 coming from the initial high of the earnings gap down, it strikes me as fairly healthy, right? Clearly a higher set of lows, watching eventually for the breakout there. Anything that crosses to the downside here, not interested. I'm also not necessarily looking for shorts in that particular instance. So that was number 2. And then last but not least, we have BMY, if I could get the order right, for Bristol Myers Squibb. We have an inside day here on our chart. Notice that we have a big hammer on the Tuesday session, little hammer on the Wednesday session. They are inside, or at least today's session is inside the prior days. Where is it happening? Again, at daily support here, right around our 50 SMA. Technically, it is underneath, but nothing in technical analysis is exact to the penny. Sometimes it is, but not often. So if we can take out the container bar high, the big hammer high, looking for a rotation back up towards the top of this overall range at 78, right? And from there, you could even monitor for continuation of a larger breakout of this level, right? Because that technically is a pressure cooker top. If you get in down here and you're looking for this, tight risk, stop goes somewhere underneath the low of the inside bar. From there, your reward is up here. And if you get follow through, it's icing on the cake. So that has been the midweek market update. If you enjoyed today's video or learned anything new, let me know in the comment section or by giving the video a thumbs up. Don't forget that our live streams, there we go, are going to be happening every single morning, roughly around 8:30. And with all of that being said, I wish you a green trading week.